Manishi Ray Chaudhary is here with us. Manishi, thanks very much for taking out the time. Really appreciate you waiting by. Firstly, let me ask you, how is it being at home? I mean, I know a lot of people, it's difficult for people to get used to the routine of being at home when they're so used to being in office every single day.
Yeah, it's a new experience for all of us, but we understand that these are a completely uncharted territory. I mean, completely different times, and we have to adjust to this new reality. Once one gets used to this, it's okay. I mean, it's not too difficult to kind of step up to what's required of you. So yes, I mean there are problems, there are difficulties, but we will get used to them as we go along.
You think this is the new reality of the equity markets as well?
I hope not. The kind of volatility that we are seeing with the VIX, remaining above 50 to 80 in that range for such a long period, it's a rarity, and I only hope that it doesn't continue like this for too long. But at the same time, that's in the realms of hope right now. And in times like these, there's almost no fundamental analysis that actually helps us in trying to figure out what a fair valuation is, or what the bottom of the so-called bottom of the market could be, because there's a completely extraneous variable that we're looking at, that we're dealing with, and that's the proliferation of this virus. So I think everything is now contingent on that. So we need concrete signs that the proliferation, that the spread of the virus is being controlled worldwide, and particularly in the developed markets like the United States, to be able to say that the markets would get back to normalcy at some point of time. So basically, the control of the virus is now a precondition.
Right. Manishi, just want to get your sense on a whole host of metrics that everyone's been watching out for. So, market cap to GDP compared to the global financial crisis, not there yet, but very close to it. I think global financial crisis was about 51%, we're at 56% now. Valuation matrix away from mean. So we're 2 standard deviation down from the 15-year mean in terms of valuations. Do we look at that? Do we look at pricing in terms of individual stocks and how far they've come? That's probably not the best way to go about it. And also then do we look at the fact that if you want to invest in a particular business or a particular company, it's the value that the company brings to you at this particular price that you need to look at, and probably cut out the noise around.
All these valuation matrices that you talk about, yes, they are justified, they are perfectly okay, but I think they would apply to slightly more normal circumstances, and the kind of circumstances that we are living in, they're clearly not normal, and this is completely uncharted territory. I mean, we have never been here before. Now that said, as you rightly mentioned, the market itself is significantly below 1 standard deviation lower than the long-term average. There are quite a few stocks, and some even good quality stocks, which are possibly trading even below that threshold. If I look at the absolute valuation parameters, I think Nifty or Sensex or MSCI India is somewhere around 12.5 to 13 times. That's just about 15 to 20% higher than where the multiples had reached during the global financial crisis. So I mean, it could be tempting for the long-term, long-only investor to buy into some of the good quality stocks at this point of time. And obviously, quality would be the first to bounce back when we gradually move towards normalcy. But when that normalcy would approach us is a $1 million question. I don't think anyone has the answer to that right now.
Manishi, morning, Neeraj here. There are a few things that are happening alongside this fall as well. India, in the last 1.5 months, has announced a number of things, including the intent to privatize some of the companies, which might now either be put on the back burner or might happen at very low valuations. How do you dissect that piece of the puzzle? Ahead of this carnage, the view was that public sector units are very under-owned and cheap. Oil and gas companies are looking extremely cheap, and they've probably become only cheaper. How do you view that piece of the puzzle?
This corporate action that you talk about, privatization or stake sale by the government, I think at the present valuations, it would be a challenge, because not just the government, any owner of any company would possibly hesitate to sell stake in their company at the present valuations. So we have to again come back to that question of when the market would approach normalcy, and therefore the valuations would possibly go towards the long-term average, or something justifiable in the minds of the owners, which would possibly induce them to come back to the market. So this is something that we have to wait for. Apart from that, I think the intent on the part of the government in trying to sell off the public sector units, that's excellent, that's great, and we are actually seeing concrete signs of the government moving forward, which is unlike what we had seen in the past few years. I think once the market gets back into a relatively more normal state, all these factors would add a significant tailwind to the market. But then again, I would repeat, we have to wait for that normalcy to come back, and the precondition for that is a control of the proliferation of the virus.
Manishi, just trying to understand what your set of clients are talking about doing when it comes to the Indian financials. I mean, the stocks are falling or have fallen until yesterday like there is no tomorrow. Today, the Bank Nifty is underperforming, by the way, and money is moved out in droves. So what is it that people are doing? Is this essentially a general risk off for EMs and Asia Pacific and India, and not a company-specific call that is being taken? Or are there also company-specific calls? Because I would presume that, if anything, a large-cap financials like HDFC Bank or a Bajaj Finance or a Kotak Bank would be the best place to weather the downturn.
You see, in case of India, the problems that the banking sector is facing is possibly, in a perverse sense, if one could use that phrase, an icing on the cake. All the markets, entire emerging market complex is currently facing this risk-off scenario where the money, therefore, is flying out of emerging markets more into developed markets, treasury bills, or even bullion like gold, etc. But in case of India, apart from the concerns arising from the economic lockdown and the proliferation of the virus, the banking sector crisis is an additional risk factor, and these few things are actually interrelated, because if one looks at some of the sectors like telecommunication, where there's now a concern about some of the frontline companies facing a situation where they're unable to pay back the loans or pay interest, or even some of the smaller companies, let's say auto ancillaries or the automobile dealers who are facing similar cash crunch. There are quite a few small and medium-sized banks and other lenders who have significant exposure to these sectors. Coming back to your original question, how are the global clients looking at this situation? I think they are pretty much hiding in the large frontline private sector banks in India. I think the appetite for the public sector banks or the NBFCs or the second-tier private banks in India is very low right now. It is something that we are recommending to investors as well. That kind of an approach to the financial sector in India.
So Manishi, just to get the clarity, you reckon that the selling that has happened I'm not asking you to comment on specific names, but the selling that we've seen in HDFC or Bajaj Finance, etc., the bluest of blue chips, is because money is just moved out of India as a basket and not necessarily a company-specific view, or is it a mixture of both?
I think, money has moved out of India as a basket, and in particular from the financial sector. So we have seen more outflows from, say, Indian financials than, let's say, Indian IT or Indian consumer staples. If one looks at the total quantum of money flowing out of these sectors and sort of divides it by the market cap of the sectors, it would be much larger in proportion, as far as the Indian financials are concerned.
Right. Uh, Manishi, there are at specific points, specific segments, and these are smaller segments, that have suddenly started becoming more attractive, depending on the phase that we are in. So, at a time when we had just started seeing the impact from China, and when China was the epicenter of coronavirus, at that time, specialty chemicals, because of the the edge that Indian specialty chemicals will have, because their Chinese counterparts were out of business at that point, got these stocks active. Now we're talking about the fact that private labs have been approved for coronavirus testing, has got diagnostic stocks active. Do you think that there is value to look at such businesses over the long term, or these are just event-based activity that you're seeing?
Well, some of these are event-based. Some of these examples are also beneficiaries of long-term behavioral change on the part of the people of a country. In fact, some of the best examples in this regard come out of China, where the Chinese internet companies, the e-commerce or the food delivery companies, they have been sort of collateral beneficiaries out of this situation. And and as a consequence, those e-commerce companies, the social media companies, they have actually outperformed very significantly. In the context of India, one can certainly look at some of these, the pathological laboratories, or some of the drug companies which are into manufacturing of those category of drugs which could be applicable. I think in case of India, even some of the consumer staples companies, they would be relatively defensive at this point of time. Some of the IT companies are clear hedges against the depreciation of the rupee, which has possibly been one of the worst performing currencies in this present context, possibly the second or third worst right now. So there are certain such pockets to be found almost in every market, but one has to obviously tread very carefully in the present context.